Hello. Hello, everyone. Good evening. Good evening again. It's wonderful to see you. To those of you joining us, I know many of you are joining virtually today, perhaps from Europe or the US. Good morning. And to you here in Bangalore, welcome to Wipro. As I speak to you today to share our Q1 results, I am both humbled and excited. Humbled to have had the honor of leading this incredible company for 2 years now, and excited for what lies ahead of us. As always, I will share with you a view on the demand environment and offer some details, right, on sectors, markets, service offerings, as well as business outlook for the quarter ahead. Okay? The reality is, despite the uncertainties of the macroeconomic environment, if I look at our pipeline, our order booking, and the discussion we are having with our customers, there has been no slowdown or pullback of spends for us. The demand for our IT services is robust, and I'm thankful for that. Our overall pipeline is in fact at an all-time high. And it continues to be renewed even as we are winning deals at a good pace. High growth services like cloud, digital, engineering services, cybersecurity are seeing strong interest from our clients. We know that. And led by our full stride services, cloud services, more than half of our bookings today are attributable to these strategic focus areas. We believe this rotation, by the way, to high growth areas is going to accelerate. Our bookings in cloud are up 35% year on year, and engineering services bookings have literally doubled. Overall booking for the quarter were, I would say, very solid. Our bookings in total contract value grew at 30% plus year on year. And in annual contract value, it grew 18% year on year. If we look at our markets, 3 of our 4 markets grew upwards of 25% year on year in total contract value terms. I have shared this with you in the past, that large transformative deals are a key pillar of our growth. They provide excellent opportunities to showcase our capabilities and scale. And I must say, I'm pleased to share that our large deals bookings were nearly $1.1 billion, which is almost 3x, 3 times more of what we did last quarter. And the majority of these were new. Our revenue growth during the quarter was at 2.1% in constant currency terms, and 17.2% year on year. We grew 15% and more year on year across all markets. We're investing heavily in talent to support our ambitious growth. For the year, we added 15,000 net new talent during the quarter. In line with our strategy to reinforce our cloud and consulting capabilities, you probably remember we completed the acquisition of Rising last quarter. Rising is a global SAP consulting firm, one of the leading strategic partners in the world for SAP. And Rising will become a critical extension of Wipro's SAP cloud practice and Wipro full stride cloud services. Our Q1 operating margins, as anticipated, were lower at 15%. And this is because we are investing in solutions and capabilities for us to further strengthen our position as a strategic partner for our clients. We've also accelerated structural transformation by investments, key investments, in freshers and in IT in particular, that will help drive operational efficiency and agility. The inorganic bets we made to accelerate our growth are presently, obviously to be noted, diluting our margins by 2.3%. At 15%, though, we believe we have bottomed out. I will now provide some finer details on markets, right, service offerings, and on sectors. As I said, all markets grew double-digit, with Americas and Europe, our top two markets, growing at 18% and 16% for the quarter in year-on-year constant currency terms. Let's deep down now. In Americas 1, we grew 20% year-on-year in the quarter, with all sectors showing strong growth. During the quarter, technology products and platforms grew 37% year-on-year, and communication, media, and information services grew 26% year-on-year. In Americas 2 now, we grew 17% year-on-year in Q1. Financial services and manufacturing truly led the performance, recording a massive growth of nearly 30% each year-on-year. This order book in total contract value terms grew also nearly 30% year-on-year in Q1. Now, European market. Our European business delivered a year-on-year growth of 16% in the quarter. UK and Ireland, Southern Europe, which is France, Italy, and Spain, and Benelux, which is Belgium and Netherlands, grew at or over 20% each of them. Our pipeline also is robust, and we won many large deals in the market. Our order book in total contract value terms grew at 40% year-on-year. Finally, our APMEA business grew at 15% year-on-year in Q1. Regions that did particularly well during the quarter were Australia, Southeast Asia. Overall, the order bookings in total contract value terms here were even more robust, growing at 60% year-on-year. Continuing to strengthen our client relationships remains our top priority. We have created a segmentation strategy to grow in key markets by deepening our relationship with our existing clients, but also by bringing on new clients who are looking for a strong business and technology transformation partner, right, to help them digitize their business. And like I mentioned before, we are pivoting our go-to-market investment to allow us to do that. As a result, our top 5 clients grew 26% year-on-year, and our top 10 clients grew 22% year-on-year, both in constant currency terms, to be clear. In the last 24 months, we have doubled the number of clients in more than 100 million segment, from 10 to 20. We also added 8 clients in the more than 50 million segment in the last 12 months. So this strategy is been paying off every single quarter. From a service offering standpoint now, you remember we have IDs and ICOR. I'll go through each of those two global business lines. On the IDs business line side, we grew 21% year-on-year in Q1. This growth was led by digital experience, where we grew 25% year-on-year, was led by domain and consulting, which grew over 45% year-on-year, and finally by engineering services, which grew 18% year on year. Now, on the iCore side, our other global business line, we grew 11% year on year in Q1. And you will appreciate that this performance comes against a backdrop of accelerated rotation of the portfolio to the new high growth areas I talked about earlier. Which ones? Cybersecurity services led the growth with 34% year-on-year growth. Improved customer and employee experiences are fueling this growth in iCore. Our customers want us to reimagine traditional services such as end-user computing services or human resources outsourcing. Leading with business solutions has been one of our key differentiators. Our role as cloud ecosystem orchestrators with Wipro Full Stride allows us to increase opportunities to grow our business. Last month, we hosted our first ever Full Stride Sales and Partner Summit in America, featuring 23 of our cloud partners. Together, we strategize around new opportunities and committed to working together to help our clients transform in the cloud. And let me tell you, there was tremendous energy across our teams. And in the market, we are partnering closely with Microsoft, for example, to help one of our large healthcare clients transform their legacy infrastructure to Microsoft Cloud. Now, our engineering services, said, has grown tremendously. It has, from a revenue standpoint, actually grown at a compounded growth rate of 4% over the past 4 quarters. Now, given the depth of our services and capabilities here, I can proudly say that we are a true leader in engineering services. This week, we have launched Wipro Engineering Edge, our full stack portfolio of engineering services. We know this will enable our clients to innovate at scale. This also extends our engineering heritage, if you remember, by combining capabilities in cloud, 5G, AI, Industry 4.0, IoT, and silicon design. Engineering Edge is already having an impact in the market. For example, a leading mobility technology company has selected us as an extension of their global engineering team to support them on the development of software-defined vehicle applications, SDV offerings. We also won a multi-year engagement with a leading US-based semiconductor to provide VLSI and system design services across their range of products globally. We will help them meet the quality standards required for semiconductor chips used in applications such as high-performance computing, self-driving cars, design and visualization, deep learning, and AI. I will share a couple of other examples, before I move on. Wipro has won a strategic engagement to assist in the digital transformation journey of a leading US-based fund administrator. We'll provide a range of services, including digital contract management, cloud migration with Wipro Full Stride cloud services, quality and process engineering, as well as create a talent transformation roadmap for the client's workforce. Wipro has entered a multi-year strategic agreement with one of the world's leading energy technology companies. Here, we will reimagine the HR experience for the firm's 6,000 employees across 75 countries. I will now share a view of our talent landscape. You may remember I had shared earlier about a shift in our talent strategy towards fresher intake. In line with that, we have onboarded over 10,000 freshers in the quarter. Now, while we are on the subject of talent, I want to share that our attrition, which is, as you know, something we are following in our industry, our attrition has continued to moderate. That's 3 consecutive quarters of improvement in employee retention is a positive sign. In Q1, it was down to 23% on the trailing 12 months basis, and we expect further moderation ahead. Our talent investments, I believe, are paying off. If you recall, we announced moving to a quarterly promotion cycle, which is very new. We were on the yearly cycle, and that will be effective July 2022, so literally this month. And salary increases for all those eligible in September 2022. Before I close, I will share an outlook for the next quarter. We have guided for revenue growth of 3 to 5% sequentially, which will translate into a growth of 11.6 to 13.8% to be precise, on year in constant currency terms. With this guidance in Q2, we will very comfortably grow in double digits for fiscal year 2023. In summary, all our markets are growing. We've doubled our 100 million strategic accounts. Our order bookings are strong, and our pipeline is at an all-time high. Very optimistic about the rest of the year. And on this note, I will hand it over now to Jatin for his comments.
Thank you, Thierry. I'll share some data points. As you know, we grew 17.2% on year-on-year basis, and our profit for the quarter was 25.6 billion Indian rupees. Our ETR, which is industry leading, was 23.7%. We had a Forex realization of 77.81, and we had $3.9 billion equivalent of Forex hedges at the end of the quarter. We converted 68% of our net income into operating cash flow over trailing 12 months. And as at the end of the quarter, we had $3.9 billion of gross cash and $1.7 billion of net cash. We have given a robust guidance for quarter 2 at 3 to 5% sequential growth at the exchange rates which are mentioned in our press release, and we'll be very happy to take your questions here.
Please introduce yourself and go ahead and ask the question.
Hello, check. Yeah, hi, I am Ayushman from the Mint. First one is for Thierry. So your outlook for the September quarter of 3 to 5% is significantly higher than the June quarter's outlook, right? Given the concerns about an impending recession, so what sort of gives you that confidence of a strong outlook? That's, yeah. If you can.
I mean, couple of things. One, you're right. I mean, like you, we read the newspaper every day. We see what's coming and what's going on in different places of the world, you know, and I think we keep an eye on it, and we stay very vigilant on what may happen. But the reality is that if we look at the real facts, which are the performance in sales of the last quarters, the quality of our pipeline, the quality of our, you know, the trend, and in particular the trend of the last weeks, we have seen an acceleration in the first quarter of, you know, the volume of business. I think, you know, that's how we are confident to deliver 3 to 5%. It's not that different from what we've delivered over the last 7 quarters, to be clear. this quarter, and we had said it was a little bit of a slowdown from a number standpoint, but frankly, we've continued to see a very good growth in the business. The interactions we have with our clients across industries, across market, the level of impact that we have with our clients, all of that is giving this level of confidence that, yes, indeed, we will deliver this performance within this range of 3 to 5% for the quarter.
So you don't see a slowdown in spending?
No.
As of now? Okay.
No, as simple as that, no.
Okay. Next one is for Jatin. So the net profit has sort of declined about 21% YOY. If you can just explain that.
Yeah, sure. So, let me share three components there. Of course, the operating margin is 15%, but there are a couple of points there which are result of what was in the base as against what happened in the current quarter. And if you see what happened in quarter one of last year, we had a very competitive tax rate. We had a large reversal based on the settlement or a closure of an audit which we had in overseas. So that has impacted, meaningfully. About 5-6% of the decline has come from that. Second, if you see, is the other income, which is significantly lower, roughly 50% compared to where it was in quarter one of last year. And there, the reasons are two. One, we declared a large dividend in March, and we paid it out in early part of quarter one. So the volumes came down. And the second is, as you all know, interest rates for last 12 months really went down. So what the cash that we have, we are carrying the yield on that, which was invested when the interest rates were lower. But as we go forward, one will accumulate more cash out of operations, as well as the interest rates, as we all know, are going up in economy. So you would see some benefit coming back. So these are the three components. Thank you.
Okay, thank you.
Okay, good evening. I'm Uma Kannan from the New Indian Express. Americas and Europe are your top two markets that you mentioned right now. So given the current macroeconomic headwinds, how are you looking at deal activities of your acquired companies, Rising, Capco, and other companies in the coming quarter?
Always the same lenses, through the same lenses. The quality of the pipeline, the quality of the bookings, the feedback from the customers, the trend of the accounts we have. Solid performance from Rising, from CAS, solid performance in terms of bookings of our acquired entity. So, there's a good level of demand. Again, frankly, we are not, our clients, when they want, there's one thing possibly that has changed in the focus of our clients. It's not the need for investment in technology. It's more the reason for the investment. And I believe you might see more programs driven by our clients that are, focused towards driving productivity improvement. And that's all fine, because we are very well positioned to help them in this journey. So, but the demand, technology, I continue to observe, and it's not even me saying it, it's our clients saying it. Technology is not a cost. It's an investment. It's a way to transform and improve productivity. And that's probably why, even in a cycle where there is a little bit less optimism macroeconomically, companies continue to invest in technology.
Thank you.
Thank you.
Hi, Chandra Shrikant here from Money Control. Here, right
Where are
here,
you?
right at the back. Here. Hi.
Of course.
Good to see you in person, finally.
Yes.
Thierry, your guidance of 3 to 5% is, at the upper end of what analysts were estimating, because at the upper end, they expected 4% or 4.5%. So I want to ask you again, what's giving you confidence in the current environment? Because when we heard your peers last week, there was an air of caution in their commentary. They said, we are vigilant. So what's giving you confidence? What are you doing different differently? If you can give us a sense of that. Because even though technology is recession-proof, the kind of projects that will come on stream will change. You know, it will not be discretionary, but it will be cost-saving.
True.
So if you can give us perspective on that.
Well,
Yeah.
you know, the way we are following our business, you know, it's always difficult to predict what's going to happen in 12 months. But in, you know, in the next 3 months, it's not even that. In the next 2.5 months, I think we have a pretty good visibility. Now, of course, you know, cannot predict if a major change happens in the market. But today, you know, we have, you know, we should not underestimate the impact of a very strong performance in bookings in this quarter, after a performance that had been already rather good in the previous quarter, and the volume of order book, if you like, or a backlog that it's creating for us in the next quarter, in the coming quarter. Second, we've invested in capabilities and in capacity, right? You probably have seen our utilization is actually lower, but because we knew we needed to be able to, you know, staff this demand that is coming for this quarter. And we knew that. And so we've geared ourselves to be ready in order to deliver it. So, you know, the level of confidence is good from the team, frankly, whether we speak to our leaders managing the markets in America, in Europe, or in Asia Pac. The perspective is promising, is good. They don't see slowdown. And it's true across sectors again.
So you're on track for another year of double-digit growth?
Yes.
Okay. Just an additional question, Jatin, you know, you've mentioned that margins have bottomed out at 15%, but what levers can you really use to, you know, take it up from here? Because in terms of travel costs, that's no longer there. There are also employees coming back to work. Pricing, I'm not sure, you know, how much you can negotiate in the current environment. So what other levers can you use?
Sure. So you know, if you look at how our margins have panned out, I would say of that 2 percentage point corridor, roughly 1/4 is additional expenditure, which is 40 basis point adjusted for forex gains that we had, and that 40 basis point is really additional travel, variable costs related with facility, etc., etc. But if you see the rest of the spend is an investment. I'll start with the first, which was very thoughtful, deliberate, and planned investment, which was Rising, the acquisition that we did. We knew there is going to be a dilution because of that. That is roughly 20 basis point, which has come in this quarter. And if you see the rest of that number, roughly 1.3%, that 1.3% is an investment in our talent. And that is depicted in P&L in terms of higher or lower utilization or higher cost of resources or higher subcontracting cost. And just to give you a numerical feel on that, all of you have our data sheet. If you see our peak utilization was 78%. We are today at rounded basis 73%. So we have taken a 5 percentage point investment in utilization. And that is on fresher investment plus also lateral, because we also publish excluding fresher what is our utilization. And even there you will see a 4.5% gap. So that is the investment that we have done, and we are confident as we go through our growth cycle in next couple of quarters, some of that will come back as that cost, that investment gets converted into revenue.
Right. Sorry, one more question for Saurabh. Saurabh, in terms of the attrition, you know, Thierry mentioned that it's been, it's moderating, but, you know, it has been at these 22, 23% levels for 4 quarters. And, you know, you're not alone. It's an industry-wide phenomenon. But by when do you see this moderating, you know, coming below 20%? Because, you know, is the market better now to hire? If you can give us a sense of that. And second question quickly. In terms of your work from office initiatives, what percentage of employees have returned, and how the new SEZ rules going to help you?
Thanks, Indra. So on the first one, we are seeing a declining trend. You know, Q4, Q1, and Q2, we are seeing a declining trend on attrition. So that's the good news. It is still heightened. It's still above 20, but we are seeing a declining trend, which is, I think, from an industry standpoint, we stand out on that count. Second, my view is that we are seeing green shoots in terms of things coming to a bit of a normalization in terms of attrition. It's not the peak that we're seeing, but it's early days, and that's the macro environment, what is happening. So that plays a role. But I suspect for at least a couple of quarters more, it will be about 20% before we start seeing some stabilization. Also, the macro environment will make a difference. But right now, as Thierry called out, the demand side is resilient. Our guidance reflects that. We make those investments. So I think from that perspective, we feel that this is the right optimal level for us to move forward from a growth standpoint. Coming on work from home, very consciously, one is our offices are open across the globe, but we have said we'll provide flexibility to our employees. And wherever the clients are wanting, so clients come first, wherever the clients are wanting, we are making sure that people are coming there. We have seen slowly a rising trend where clients are insisting more and more employees come. It's slow and kind of not at a step jump as of now, but we'll keep monitoring the situation. We are not forcing anybody to come. We're not trying the flexibility, but make sure that we have people coming in and going out, because we feel it's important to stay connected as well as the flexibility. So how do we strike the balance between the two is very critical. So it depends, for there's some clients it's very high, when 1/3 of their workforce they're saying should work from overseas. At some levels it is still, at single digits. So it's varied for different parts of the business. That's the way to look at it. It's different in different geographies right now. So I think there's no point giving a percentage, but it's in different parts. On the SEZ rules, the last one is, that 50% rule that has come for India, there's a lot of administrative in terms of looking at it. We are trying to understand it better. How do we monitor attendance? How do we, make sure that we are compliant? So we just got the rules and we are trying to study it, and we'll come back on that. But we have time on hand to make that happen. So that's where we are.
Hi, this is Sai Ishwar from the Economic Times. So Thierry, the company has given robust deal numbers, but when we generally look at the industry commentary, they say the deal numbers are good, but there is some sort of softness in terms of decision making. So are you also seeing that? I know deal numbers are happening, but in terms of decision, qualitative, do you see any impact?
So what I propose, it's the third or fourth question, and great, but I have my chief growth officer here, Stephanie, who is with the market every single day. So Stephanie, what would you like to say?
Yeah, so we don't really see a softening of customer decision making. I think, as I've said before, our clients are really thinking about their big transformation programs and how to thoughtfully implement and accelerate the outcomes that they're looking for. We've seen some customers that have take a phased approach to how they buy, but in many cases, we still have clients who are looking for those end-to-end solutions, and that's some of the large deal signings that we've had this quarter and also reflected in our pipeline. So we don't really see a slowdown in decision making, more thoughtful about how they're approaching what are really transformational kinds of programs. So very optimistic about what's in our pipeline and how we're co-creating with our clients to get the optimal outcome, and also with our partners. So a lot of good momentum from that perspective.
And to Mr. Jatin, so your finance cost has gone up, right? And you were telling about the higher interest rates and also the wage costs. So should we see this fall in profit as a more than one quarter phenomenon? I'm just, for the understanding sake, I'm asking.
We had mentioned beginning of last quarter that our margins, as we are making conscious investment in our business, will remain lower than the long-term or medium-term trajectory that we want to hit. And this is going to be for a few quarters. We will certainly leverage a greater efficiency in Q2, but we will also have further investments as we promote people that both Thierry and Saurabh spoke about. We'll give our salary increases. So we will remain calibrated and improve slowly. But as we mentioned, this margin is bottom and it should slowly improve.
And Mr. Saurabh, actually on the LTM basis also, we've shown some improvement in the attrition, right? So can you tell us, like, I think you're one of the few companies which have shown improvement. So can you tell us what is working for you? Do you think the quarterly promotion cycle is, working out for you? And if possible, could you give us that annual wage hikes, the band which you had awarded to your employees effective from September? Thanks.
So on the salary increases, we haven't decided on the percentage of increase, and we will announce it closer to the date. But I must assure that in a market like this, we have to be competitive, because as theories call out, we have invested in talent, and we need to make sure that we are in the right trajectory. I think on the attrition, there's a number of steps, from making sure that the macro environment, the engagement, the promotion cycle, how we are doing it, how we have ring-fenced people, how we look at the fresher things, how we look at the campus. So there are a number of things which have helped us in this journey. It's a very planned thing, as it's not overnight. It's now getting sustained over 3 quarters. So we are seeing a trend, and hopefully this should continue.
Just one follow-up.
If I can just, sorry, on that, because I think it's, at the same time, we're always vigilant, because, it's never one forever, right? Okay, you have to keep an eye on attrition every single day. But I think the team has done an incredible job to look at different aspects of what creates the right level of connections of our colleagues with the company. And, I would start with, the uniqueness of the values and the sense of purpose of Wipro. I think our people, maybe in the past we never paid enough attention or spend enough time to explain in which way we are different. What we've done during, the COVID time, to help, the people in needs, the communities, and so on. I think our employees are very sensitive about that. So that's, I would say, the first aspect is really to just tell them about who we are and how we are, where we are placing our priorities as an employer. And I think Wipro as an employer is a unique company. Second, I think, we've been quite active in terms of making sure that they are paid fairly, right? Several salary adjustments, accelerations of the number of promotions, accelerations of the number of rotation, and obviously the growth that we've experienced, 27% last year, has also created a lot of opportunities for people. So suddenly, people feel, hey, there's a real career path for me. Why going, right? And I think the last thing is, as Saurabh said, I think we've also multiplied the different elements that create the right environment for the people. It can go from, the impact the working from home or the hybrid model can have on women in our organization. And we see a reduction of attrition of women compared to what we were seeing at the time, where overall attrition was actually lower. But the attrition of women at that time were higher. Okay, so we are I would say, in a harder demand environment, we are able to reduce the attrition. And there's also many other aspects of, the increased volume of communication in the teams, closer connect, and so on. So I think, it's not rocket science, but I think there is a massive mobilization from the leadership team, the wide leadership team to connect with our people every day.
So with attrition coming down, do you think the fresher hiring number, will there be some sort of a moderation there? Because
Answer is no. Answer is no. So, you wanted to say?
Same thing. I was trying to give out. You gave it in one word. I was trying to give us
it's a conscious.
It's a very conscious investment.
Yeah, it's a conscious investment. We know that short term it's costing us in terms of operating margin, but it doesn't matter. It's the right thing to do for the company, for the future, for the next quarters and the next years. So we are committed to it, and we will only increase from here in the next years.
Hi, good evening. Tushar here from Financial Express. I have a follow-up question to the attrition rate, right? You have 2 initiatives kicking in, from one in July and one in September. Saurabh, can you help us understand how much will that contribute to your attrition, right? In basis points, can you tell me how much will that help bring your attrition down? Or just those two initiatives, if you can single out them, please.
I wish I could do that. It's a very complicated mathematical model I have to.
A ballpark figure, but
the point to look at is that as theory explained, it's not one thing. It's not one thing. There are a series of things. It's the environment. It's what people feel. It's the growth opportunity. It's the rotation. It's the technology they're working in. It's the clients they're working is. They're being paid competitively. They're being valued. They're being respected. I think it's a combination of all these things coming together. So I would not, look at one particular issue and say this is what will bring it down, and that's how we need to look at attrition, because long term, people don't look at only one thing, people look at number of things and stay in a company. And I think my request is we should start reflecting in that fashion of how can we sustain this over a period of time.
Hi, this is Haripriya from the Hindu Business Line. So my question was about, the chairman mentioned yesterday that you'll be stepping up investments in the new emerging areas of Web3, Metaverse and all that. So what would that route be? So how are you going to approach it? Will it be in like an organic way, or it's going to be a good old Wipro way of string of pearls acquisition that you?
No, so thank you for this question. I think it's true that we are really focused on rotating our portfolio from what I would say it was more the legacy services to what we call the new. Okay, so these are the areas where there's high demand, the areas that truly matters in the transformation journey of our clients. And he mentioned metaverse, but it's true also of 5G. It's true of the environment around data. To get companies to be more data-driven or data-centric, the investment around engineering, the way to leverage artificial intelligence, we are investing in there. And we are rotating our portfolio so that we have more and more of our deals that are in these areas. Today, cloud is more than a quarter of our business, but if you look at the volume of deals closed in the cloud, it's actually more than a third, right? So it shows the impact it has in terms of rotation of the portfolio. And we are investing in capabilities, in solutions. We do it primarily organically, okay? But we also may, at times, do it strategically with acquisition. You've seen us doing it. When we've acquired Agile, that was exactly that, consulting around cybersecurity. And this practice today is doing fabulously well for us. What we've done with, Rising, same strategy, right? Bringing consulting domain expertise around SAP, enhancing clearly our sizable SAP business, okay? When we are looking at, engineering areas, we've also made investments to continue to expand and reinforce our position. It may happen inorganically, okay, also. The point I'd like to add on inorganic strategy, you've seen we've done several deals in the last 1 year. We don't have a quota in mind. It's not like we say we want to do 2 deals per quarter or 1 per every 6 months. That's not the point. So we might do several and then not for a while. And it's based on strategic decisions. It's never tactical. It's never volume driven. It is, as you said, either to really bring new technology or in true expertise in a sector, like what we've done with CAS in the consulting, in the communication sector, or in a particular market. So that has been our strategy. Our strategy in M&A isn't changing. We continue the same strategy.
So we've received a few questions online, and I'll read. This one is from Varun Sood of Mint. At 15% operating margin, how much improvement in margin can be expected during the course of the financial year? Will it be fair to conclude that Wipro's full year margin in the current year will be less than the operating margin at the end of March 2022?
Yeah, so I'll take that. Clearly we don't guide on margins for the full year, so difficult to comment on full year comparison. I think we have been very deliberate, conscious. We shared our perspective in beginning of last quarter, as I said, that we will have a few quarters where margin will be lower than the range that we have been operating it. And quarter one has been in line with that commentary. We are staying put with the commentary, as we said last quarter. But you will see continued efficiency gain, but you will also see continued investment, which we think is the need of the hour for the organization.
The next one is from Shivani Shinde, Business Standard Mumbai, and this one's for you, Saurav. What are the hiring targets for FY23, and is the quarterly promotion here to stay?
So hiring targets is very clearly demand driven. We have called out how many freshers we want to have. Lateral hiring will be demand driven as we move quarter on quarter. So I'm not giving a number to it. And yes, the quarterly promotions are here to stay. That's the idea. Absolutely.
Okay. The next one is also for you, Saurav. This one's from Romita Majumdar of Economic Times. You have reported higher employee addition during this quarter compared to your peers who have reported lower employee growth. Will employee addition continue to remain at an average of over 12 to 30,000 per quarter during the remaining quarters, or can we expect it to go down based on the large numbers that you have already hired over the past year? What is the number of freshers you have onboarded this quarter? What will be expected fresher hiring through the full year?
So we have onboarded more than 10,000 freshers this quarter. Our total net headcount add has been around 15,000. We have called out we will be onboarding nearly 30,000 plus freshers for the full year. That continues. Balance will be demand driven. As Thierry had called out, very consciously, strategically thought through, we have invested ahead of time to make sure both in freshers and laterals so that we are ready for the demand which is coming in the coming quarters, which is reflective in our guidance and is also reflected in the utilization hit we have taken. So it's a very conscious choice we have made. And as the quarters go by, we'll see the hiring numbers. Want to add anything, Thierry?
We'll take one more from Anisha Jain, ET Now. Her question is, she's asked for the breakup of the organic and inorganic revenue growth for both Q1 as well as guidance.
That's an easy one. We don't break it, so.
They regularly try.
And there's another one which she has shared actually. Europe declined 3% Q on Q. Is this a precursor of structural downtrend in Europe business given the macroeconomic headwinds?
Declining. No, we're not declining in Europe.
Yeah. So I will just clarify that. I think her reference is with operating margin difference and operating margin difference. There is nothing more to see. There are some quarters where you have slightly higher number, some quarters slightly lower number. You have to recognize that Europe, while very large, is still not as large as Wipro. So there would be some variation every quarter that will come through. And specifically on demand in Europe, I'll request Thierry to talk.
Exactly. On the growth side, actually Europe has grown well and will accelerate the growth. So, the outlook in terms of growth for Europe in quarter two is very strong. So no signs of slowdown. The pipeline is at all-time high, and the volume of bookings in Q1 in Europe has been strong, including some large deals.
Thank you, gentlemen. I think we've completely run out of time now. With that, we conclude the press conference. Thank you, everyone, for joining us.
Thank you, everyone.